Welcome back. The Minister of Finance, Enoch Godongwana, has tabled his first budget under the GNU, and it doesn't seem to be as rosy as expected. Treasury is warning of wider budget deficits and higher debt over the next 3 years due to lower revenue collection. In the budget, the minister projected the consolidated deficit at 5% of GDP, while expecting the debt-to-GDP ratio to stabilize to 75.5% in 2025-26, with debt service costs potentially increasing due to financial conditions. And joining me now as we make sense of the statement is Chief Economist at Nedbank, Nicky Weimar. Thank you so much for your time, Nicky. There is an air of disappointment in the market. We even see the weakening of the rand during the finance minister's speech. How bad are things?
I think what this budget shows is that, I think there was this expectation ahead of this budget that you would see a big boost to revenue as consumer spending picked up and income recovered in real terms in any case, and the anticipation of, whatever the windfall gain will be from the two-part retirement system worked into the revenue numbers. And that would, given relatively sort of constrained expenditure, would produce a faster path to deficit reduction. And what we see here is that that's not the case. And I think it just reflects the fact that there are hopeful signs. There are definitely green shoots for the South African economy, but it is still a very fragile economy. It is still very weak. And the recovery, although it's coming, is still very timid and in its early stages. So the momentum is just not there to have lifted tax revenue substantially. And I think that's the one part of the story. And of course, the bigger part of the story here is I think that ultimately, unless we actually get to a point where we can lift the supply constraints on the economy, start to grow faster, start to create more employment, because that's the other thing. More employment is more taxpayers. You're always going to have a situation whereby your aims to achieve better or fiscal sustainability will require almost inhuman levels of restraint as far as spending is concerned. And I think that's the story of this budget.
Yeah, it's really quite interesting, Nicky, because, you talk about the fact that we do have now better supply of electricity, and that's for the longest time being seen as the Achilles heel of the economy, but still not enough, as much as, corporate taxes have improved, but still not to the level, the desired levels. And I'm wondering here if it's just a whole lot more that needs to be done here, where it's not just the electricity, we've got that right, but there are other things that we need to do now to actually get this growth going.
Yeah, I think the thing to bear in mind is electricity will make a difference.
Yeah.
But we have no load shedding, and we've only had it since the 26th of March. So it's not that long ago, and it takes a while for company profitability to really recover. Remember last year, was just an absolute shocker. You had demand that was exceptionally weak. You had all of these unexpected cost factors for private companies, from load shedding to the collapse in rail to the delays at the port to generally higher inflation, all of that driving up their expenses, plus higher wages, and their profitability just got squeezed. It takes time for that to recover, and the recovery is simply in too early at stages to really translate into massive boosts to profits and therefore to tax revenue for government. So I think it's still just the timing factor here that we're looking at. So load shedding will make a difference, but you're quite right. It's not the only factor. Yeah. The collapse in rail has not been really addressed. The improvement, even the ones pointed out in this mini budget, really is very, very modest. And the issues at the ports are still an issue. So those issues have still not been resolved, and they are factors that make South African exporters much less competitive.
Nicky, what's also interesting for me, because the minister came out and said that there's a primary surplus there that has been reached for the first time in 15 years, but then you have this consolidated deficit that's expected to be high. Just talk to me about what we should be holding on to there.
All right, so I think the key point here is that we are running, or we did for the first time in 15 years, in the previous fiscal year, run a primary surplus. And what is that primary surplus? It's really your government revenue, revenue minus government expenditure, But from expenditure, we exclude debt service cost.
Okay.
And what it really means is you can't avoid debt service costs.
Yeah.
That is a function of the debt built up in the years before. And the only bit you can really control is non-interest expenditure. So what it shows you is that government has applied a fairly significant amount of fiscal discipline in order to ensure that they do run a primary surplus, but your overall balance on your budget is still a deficit.
Yeah,
right.
And that debt is still a problem.
When you include that debt service cost back into expenditure, it's been the fastest growing item in the budget for almost a decade now. Then clearly it still produces a budget deficit.
Well, thank you so much for your time and for your insights there, Nicky. Much appreciated. We do have to wrap up the conversation. That was Nedbank's Chief Economist, Nicky Weimar.